Chapter 11. Regulations in Futures and Options Trading. Futures and options trading are subject to a wide range of regulations that are designed to protect investors and promote fair and transparent markets. In this chapter, we will explore the regulatory landscape of futures and options trading and the compliance requirements that traders need to adhere to. Understanding regulatory bodies in futures and options trading. Regulatory bodies play a critical role in futures and options trading. These bodies are responsible for monitoring the markets, ensuring compliance with regulations, and protecting investors from fraudulent or manipulative activities. Some of the key regulatory bodies in the futures and options markets include Commodity Futures Trading Commission, CFTC. The CFTC is a federal agency in the United States that regulates futures and options trading. It is responsible for ensuring fair and transparent markets, protecting investors, and enforcing regulations. National Futures Association, NFA. The NFA is a self-regulatory organization that is responsible for overseeing the activities of futures and options brokers and traders in the United States. Securities and Exchange Board of India, SEBI. SEBI is the regulatory body for securities and futures trading in India. Financial Conduct Authority, FCA. The FCA is the regulatory body for futures and options trading in the UK. Compliance requirements in futures and options trading. Traders in futures and options markets are required to comply with a range of regulatory requirements. These requirements vary depending on the jurisdiction and the type of trader. Some of the common compliance requirements include registration. Traders and brokers must register with the regulatory bodies in their jurisdiction. Reporting. Traders must report their trades and positions to the relevant regulatory authorities. Margin requirements. Traders are required to maintain a minimum level of margin in their trading accounts to ensure that they can meet their obligations. Anti-money laundering, AML, and Know Your Customer, KYC, regulations. Traders must comply with AML and KYC regulations to prevent money laundering and terrorist financing. Investor protection measures in futures and options trading. Investor protection is a key objective of regulatory bodies in futures and options trading. Some of the measures that are in place to protect investors include segregated accounts. Brokers are required to keep client funds in segregated accounts to ensure that they are protected in the event of a broker's insolvency. Margin requirements. Margin requirements ensure that traders have sufficient funds to cover their obligations. Trading limits. Some regulatory bodies impose trading limits to prevent traders from taking on excessive risk. Education and training. Regulatory bodies may provide education and training resources to help investors understand the risks and opportunities of futures and options trading. In conclusion, regulations in futures and options trading play a crucial role in ensuring fair and transparent markets and protecting investors. Traders need to be aware of the regulatory requirements in their jurisdiction and comply with them to avoid penalties and protect their interests.